Well, so far the bounce hasn't lasted very long. The market came down hard again this morning to the point where the S&P 500 was below 3,900. Stayed there actually for a while, but once it got below there, the traders started fighting hard, and once it had been down there for a while, they started panicking the market back up again, fighting hard to slowly get it back up again. Okay, they were absolutely determined to try to make sure that the market would not register nominally official bear market territory by the close of the day, by staying down there throughout the day. Okay, basically the market is just above that level overall by the standard definition of a bear market, and they were trying pretty much at all costs to avoid that. So the market slowly ratcheted up for the rest of the day again, except the Nasdaq. The Nasdaq, as noted, it leads on the way up. It also leads on the way down. It was down by far the most today. By the end of the day, all they managed to do, the tech index, is to hang on for dear life to avoid going to new lows. Okay, but the S&P 500 and the Dow in particular ratcheted back up. In the end, toward the end of the day, they managed to get the Dow back up above zero for the day, and then even tried really hard to get it above 32,000 again before the end of the day. They actually made it to 32,000 very briefly a few times along the way after that, but they were just wildly bouncing back and forth between 0 and 32,000 and almost 32,000. I mean, they did make it a couple of times, like I said, but most of the time they didn't quite make it. Bouncing back and forth between those two levels, trying to at least hold 0 and try to get 32,000 if possible. Okay, came down hard pretty much every time again. A few times at very near the end of the day, it actually ended up below 0 again, but then at the very end of the day they blasted it up one more time and managed to close well above 0, but also nowhere near 32,000. Okay, so they did manage to do what they so much like to do, which is try to make the end of day numbers look as good as possible. Okay, they did pull that off again, relatively speaking. Okay, S&P 500 stayed below 0, well below 0, and the Nasdaq was way below 0. So it is definitely not a healthy market. Okay, the European markets, to deal with that for a moment, again using the German market as a reference point, they fought hard for much of their day to stay well above 14,000 again. Once the American market opened, and opened way down, as I noted at the beginning of this message, they were dragged down too. Okay, again fought hard at the end to stay good, and what basically happened there is they went vertically through 0 as well, and if it had kept going like that, they would have cascaded down to a very negative number by the end of the day. But they did manage to avoid that. They panicked too and fought hard to at least hold the market into the close for the day, and managed to do that. So they closed below 0, but not massively below 0. But the point is there too, not a particularly healthy market. Okay. One other note, underlying issue of interest rates. I've noted in past videos that interest rates were steadily but relentlessly ratcheting up in stair-step fashion. Okay, they made it to well above 3% on the benchmark 10-year note. Okay, and then they started coming back down again. Now, one thing to note about declining interest rates: the more usual situation is when they're coming down fairly slowly, which means an increasingly good economy. Okay, both as a result of that and a cause of it. It is a feedback loop. Okay, But if interest rates are coming down very quickly, which is a very rare phenomenon, that means things are in trouble. That basically means interest rates are collapsing, mainly because anticipation of, or even actual in the meantime, lack of demand in the economy. Okay, right now interest rates have fallen well below 3% again, but very quickly. This is not a good sign. It is not a sign of a healthy economy. It means that either things are going bad sooner than expected or are anticipated to go bad pretty soon. The interest rate market being one of the key indicators of the economy in the marketplace, the interest rate market is a lot more immediately sensitive to what's going on in the economy than the stock market is. Two completely different sets of traders with a completely different mindset. Okay? And I think the interest rate marketplace is beginning to show what may be going on out there, along with enough warnings from enough companies about how things are going out there for them, with a combination of lack of supplies of resources for production, along with inflation going on at the same time, that it's not helping them a whole lot, to say the least. Okay, so the bottom line is it is still a weak market, even though the Dow was up slightly today in the end. And as a result, it becomes even more important to see how the next few days go. I suspect they will not be really good, but as I said, it also on the edge of going into what is nominally, from a conventional point of view, regarded as a bear market, and they're fighting like crazy, doing everything they can to avoid going into those levels on a closing basis. Okay, so we'll see what happens in that context over the next few days.